All right, markets continued slowly higher again today. It follows a theme outside of the CPI day that pretty much follows a theme that we've seen for the last 2 weeks. In fact, I'm going to break down some of the trends that we've seen over the past 2 weeks as we've been slowly grinding higher to the upside. What's been going on with volatility, what's been going on with volumes, what's been going on with trading ranges, what's driving, especially over the past few days, what's kind of driving this price action that's kind of limiting us from continuing to build on those CPI gains that were actually pretty decent last Wednesday. But since then, we've kind of had an interesting trend across some important asset classes that have an impact on risk appetite as they've been hitting and sitting on some really important support levels. So we'll break all that down in today's video. The sector rotation, a very important sector, leading the way higher today. The problem is, it's typical cohorts are not following suit. So that's kind of keeping us from being as bullish again as we want to be. But that doesn't mean we can't take advantage of some bullish breakout opportunities on an individual basis, and that's what we do with our trade idea of the day. So let's go ahead and get started. Today is Monday, May the 20th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers. So thank you to those who do this day in and day out. We really appreciate that. Our goal is to get to 100 likes. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So you can see we continued higher again today. Again, another small range, under 23 points. The average ATR now is below 50. It's down to 47. I mean, just for some context on where this ATR was, just a little bit, just 2 weeks ago. So let's see, this would be May 20th. So let's go back to May the 6th. So there's 2 weeks ago right here. The ATR was at 6 1/4 points. And now we're 4 2/3. I mean, it's a dramatic drop in the ATR and the volume for that matter. The average volume is 72 million. So just for some context on what that number means, 72 million shares, and let's just do, we'll just do the close based off the close here. 72, let's see, it'll be May 6th. So 72 million. Times the closing price on that day, just to kind of give an estimate of how much money is moving. So you're looking at, what would that be, $37.25 billion, $37.25 billion exchanging hands here. That was May 6th. 2 weeks later, again, using the closing price, which is not very much different than any other price that day since the range is so small, using the closing price times today's volume, and now we're looking at 30 million, right? 30 million shares. So you can see it's a big drop. That's about what would that be? $7 billion less over 2 weeks. We've lose about $7 billion in money flowing through the system. Just from one, I mean, and again, this is not like May 6th was a big day itself. It was also very below average range days. So, but the 20-day average volume there is much. I mean, we just continue to get this really dropping fast. In fact, if you were to do a percentage drop on this, it's a 20% drop in that average volume in 2 weeks. And if we were to look at the range here we'll just pull up another calculator and bring it over here. Remember, the ATR is now at 4.64, and on May 6th it was at 6.23. That is a 25% drop in the ATR, and that's a 14-day ATR. So 25, again, it's a pretty sharp drop here in volumes and ranges and participation. We're just not getting very much participation in the markets, and that's why you're seeing again, the intermediate line still bullish, right? It takes a lot more than small ranges to pull the intermediate line down. But you notice your momentum line's still in bearish territory. Your near-term line's been declining now, as you're not really moving higher anymore. Still in bullish territory. Your intermediate line's still above market sentiment. So we're still bullish. Still got dark green shading and a green line. But we're just not really pushing. You can see we got above the 2.5% mark. Back here was last Wednesday. We got above the 2.5% mark on that CPI day, and then we just haven't really extended. We're still only 3.33% above, and you can see that's not necessarily the case on the Nasdaq. The Nasdaq did push a little bit more higher today, up to 4.25%, and the momentum line did jump up into bullish territory. Whereas if you look at like the Dow Jones Industrial Average, which is actually down 0.5% today, its momentum line dropped to extreme lows, and its near-term line dropped into the lower half of the chart. Still got a strong bullish posture, still got rising long-term market sentiment. The intermediate line's well above it, so it's not like we're bearish here. But you can see the difference in the short-term sentiment. You also see too, we have again strong bullish posture on the Russell 2000. Momentum line jumping into the upper half of the chart from extreme lows a couple days ago, but still like no range. I mean, this is half. The range on the Russells is half of what the average is. So very, very small, and a lot of that may be attributed to the markets just saying we're not going to do anything until we get NVIDIA's numbers, and then we'll figure out what the market wants to do from that. It seems like whether it's CPI, whether it's FANG earnings, whatever the case is, it seems like there's one thing after another that the market, whether it's the FOMC meeting, it's one thing after another that the market's just like not moving until we get that event, and then we get a movement, and then we go back to not moving, kind of like what happened with the CPI here last week. We do have a good bullish candle on the Hakinyashi. Again, we're only one day into it, but we don't have a higher high yet. Otherwise, this would be the high point. But we do have a higher close, so that's a good sign. So the Hakinyashi differential is below its moving average slightly, not too bad. So we're not too we're still pretty decently bullish on this. Obviously, you have 3 green arrows across the board. We're well above moving averages. Even with MACD histograms falling, we're still okay. So no threat there to a red arrow yet anytime soon. If you look at the 2-line versions, of course, your 8 and 17 day are well above the 30-day moving average. The MACD is still moving higher, hasn't peaked yet, much less fallen below its moving average. Remember, falling below that moving average is kind of a first step of convergence, right? It doesn't necessarily mean we're going to be dropping. We could still go up higher even with the MACD below its moving average, right? That's convergence mode. But we haven't even got to that point yet. The MACD still is actually moving slightly higher there. Looking at some of the other oscillators, obviously your DMI is still showing a bullish pattern. Your ADX now is rising up above 20, so you got the green shading now. ADX is the negative indicators below 20 to positives above 35. So very good bullish pattern there. Remember, we've had which is pretty rare to get a ADX above 40 on a bullish move anyway. The last time before this past year, the last time we had one was coming off the COVID low, and then right before the COVID peak, we kind of had some parabolic moves. But these two were even bigger than both of those, and they occurred back to back. So it's not common to go parabolic, and we've been going parabolic. And right now, it looks like we're trying to make another trending move here without a real significant, with even a smaller bearish move than what we had between the last 2 parabolic peaks. If you look at the RSI and the CCI, obviously you're still at bullish levels, above 60 here, above 100, so those green shadings can just keep going over to the side. Looking at the Ichimoku cloud, we have an intermediate trend strength going above 2, above 65. Above the cloud, above the green line, positive rate of change. Everything is just looking great there. Looking at the Bollinger Bands and the Keltner channels. Again, we are in the upper quartile, though we are not pushing up against the upper band yet. But we are at least in the upper quartile. The bandwidth is still pretty high, maybe peaking there. Your momentum is very high. Only the strong momentum move we had coming off the Halloween low point was a stronger momentum than what we're seeing right now in the past year. And if I were to go out the past couple of years, you can see if I were to move this, let's activate that and move it up to where we're at here, a little bit closer right there. It's the strongest momentum move before that since this whole thing started, since the washout low in October of 22 and the bullish move we had coming off of that. So needless to say, it's a pretty strong bullish momentum move, especially without ever really getting above or even up against the upper Bollinger Band here, and with the bandwidth already pretty darn high. Again, very similar to the type of move we got back last November, but you have to keep in mind volatility was a lot higher back then than it is right now. If I were to take a look at today's intraday chart, you can see we have a higher high and a higher low, both of them pretty much up at yesterday's high point, slightly above last week's high point. We have a pretty decent range. The range is well above 5%. It's pulling back a little bit there, but the low is all the way over here on the right, or left. The high is all the way on the right. That's very, very bullish pattern. We are nowhere near getting the stochastics down to any kind of weak level. It's still very, very strong level up above the 90th percentile. So very good from that perspective. Obviously, I showed you today's trading range and volumes, very low. The range is at 2.39 points. The volume at 37 million, just very extreme. So when you look at the price here again, the volume is just so far well below 52-week lows. And today's volume off the charts compared to the average. Today's range off the charts compared to the 52-week range of the average. And of course now well below 0.9%, or 0.9% on the normalized ATR. So back to just very, very extremes. Again, I've mentioned over here before, we kind of had a similar move, to where we dropped down to about this level in a pretty quick manner going through November expiration. You can see the volume drop to, but not to new lows. You can see it drop to lows that we saw over here. We are not very far up above price here, but the volume is just dramatically lower, which is why your money flow, despite the fact that we are obviously up to higher highs even today, compared to where we were when volume peaked. This is when volume peaked here. Obviously much higher than that, though nowhere near that level on the money flow, which is again this normalized volume. Volume and money flow indicator index is at bullish levels, so we do have bullish volume here, but it's not been strong enough to compensate for this, for the volume that we had to the downside, and the retest of that downside at the end of April going into the beginning of May. And then finally, let's take a look at volatility levels. You can see still very low. We did finish above 12. We finished below 12 last week. We're finished a little bit above 12 today, so a little bit of a move higher, not very much. We're still, in bullish levels here from a risk appetite standpoint with volatility down, which means that the VIX 3M was also up today, but it's at such extreme lows, and your VVIX is moving higher. The correlation between the VIX and the VVIX is still at negative levels, not all the way down to negative 50%, but negative 25%, still pretty strong for an indicator that's rarely even negative at all. For a correlation, it's very rarely negative. So VVIX has been rising while the VIX has been making this kind of newer low over the past week. All right, now let's break down what's driving the price action here today. And we'll start off by taking a look at this asset class comparison chart. You can see gold remains, even with a little sideways action here over a multi-week period, now back up to new 3-month highs, just by far the outlier here in terms of how things have been moving over the past few months. If I look at how the markets moved here today, let me actually get to May here. There we go. You can see gold had a pretty decent day for a while. Commodities stayed pretty strong. The dollar was up. Yields were up. Bonds were down. That's your three-headed monster. Now, it didn't really put a lot of pressure on equities, though they were only up 0.25% in a very small range. And that's been, again, we've been monitoring those three asset classes very closely as they've been kind of, the dollar went down to the 200-day moving average, still is below its 8 and 17 days, so it hasn't turned up yet, but you can see it hasn't broken the 200 either. The 10-year yield also held its 200-day moving average, has bounced up the past few days. Again, has not broken the 8 and 17 day yet, but you can see it's held so far. And then commodity prices have broken through in a pretty significant way. The 8 and 17 day are about to cross the 30 and the 200-day moving averages. MACD and stochastics pretty strong, pretty decent volume down there at the bottom. Crude oil really not a big driver, interestingly enough, for that. Even though its MACD is above its moving average, in a convergence mode, because you're not above the 17-day yet. You're still holding the 200-day. You're still holding the point of control. The stochastics is moving higher. So all three of those things. So if I look back now at that asset class comparison chart, and we look at the past 3 days where, again, we've been off of that low point. So it's be starting here on the 16th. You can see that commodities are up over 2%, gold being up over 1.5%. The dollar's up strongly. Yields are up pretty significant with the TLT down 1%. That's your three-headed monster, and that's why, like, for example, the IWM is down 1/3%. Crude S&P is flat at best, a little bit of a move higher in the Qs. But you get the idea here that we may be in for a move higher in these risk-off assets. At least have been risk-off in the last few years, right? Those three in particular. The breadth today was not bad. If you take a look at the breadth and see what it did, you can see the McClellan oscillator is still positive. It's not above 35 anymore, but at least it's still positive. When you look at the here, let's look at the number of stocks above the 50-day moving average dropped, still well above its moving average, but down just a little bit there, and you can see it hasn't dropped over 5 days yet. Still positive over the past 5 days. You can see the number of stocks above the 200-day moving average. Got above 400 last week, a little bit below it by one stock here this particular week. The skew, which jumped up big on Friday, up to 147.5, dropped back down, but still above its moving average, which is still bullish from that perspective. The number of new highs and new lows stayed relatively strong, well above the average, over twice the average, and sitting there at 361. So very strongly positive, good bullish trending level. Even if it's not, increasing, at least they're still at levels that are trending up to the upside. If you take a look at the ratio of the Qs relative to IWM, again, we're worried about the breakdown because a breakdown below that 200-day moving average would most likely be coordinated with more of a pullback in equities. Again, that's the kind of pattern that we're seeing here in this relationship of discretionary stocks to XLP. It's also the kind of pattern you see when you look at financials relative to utilities. Also haven't broken its 200-day. Technology had broken its 200-day, but at least has rebounded back up above it. Discretionary services has never broken its 200-day yet, relative to the S&P, of course, but still kind of sitting between moving averages, holding the 200-day barely there. And of course, XLU relative to SPY, which is a risk-off relationship, is above its 200-day and getting, even with momentum waning here a little bit, still holding that breakout move, which again is, right now it's got a small positive correlation with the S&P, but generally is a negatively, because this is more of a risk-off relationship here. One thing to kind of keep an eye on too is, let's go the other way around. Let's look at SPY relative to the equal weighted index. Again, this is something that's generally speaking, if I were to take a look at the weekly chart, you can see it's generally very positively correlated with the S&P 500 with risk appetite in general. Obviously here more recently it's been kind of fluctuating, oscillating here, but the ratio of the S&P relative to the equal weighted index is still at one of its higher closes. In fact, this is the highest close that we've had going through these two right here, and then this one back here in early February. So in other words, equal weighted stocks are at their lows relative to the S&P that we've seen here multi-months. And of course, those highs over the past few months are the highs, are the all-time highs for this particular ratio, or at least multi-year highs going back to 2020. And you can see going back to even 2008, 2009 was the last time the SPY was this bullish relative to the equal weighted version of itself. Let's take a look at how the sectors performed here today. So we go to our sector rotation chart here. And you can see, okay, utilities maintaining strength, not increasing, but still maintaining its strength. Again, looking over the past, let's look at today first, and then we'll look over the last 3 days that we've had that three-headed monster reemerge. But here's today, and you can see XLK doing very well today. XLC not so bad. Discretionary struggling, along with financials down there. With the market kind of flat. Again, let's go back to the last 3 days. So we'll go to May 16th. And you can see technology, which had been the biggest loser over the past couple of days, rebounding pretty nicely. Discretionary services also kind of rebounding there. Kind of hanging out there with staple stocks, which started off the day last Thursday pretty strong. Have pulled back a little bit the past couple of days. Whereas discretionary stocks are your biggest loser, along with real estate, which has also kind of been a cyclical area of the markets lately. They've been the biggest losers here, and even utilities has been unable to build upon its really strong multi-month gains. Remember, utilities has had such a strong rate of change here. Utilities. This is over the last 26 days is up to a 12.5% mark. Again, for context and just how bullish that is, you can see we don't really get bullish moves that big. This is a very strong move for utilities, and it's generally hard on an absolute basis to maintain that. Now, can it continue to go higher on a relative basis? Yes, if the SPY, even if the rate of change declines, if SPY drops more than what XLU does, then you can see that ratio would continue higher up above that 200-day moving average. Is kind of why we kind of watch that so closely here. And you can see it is the relative rotation graph here. We're looking at just the 1 day. Utilities still maintains very strong relative strength. XLK and real estate gains some. XLK is still kind of barely in that positive rate of change. XLY is losing momentum and relative strength. XLC was in the improving, working its way up. It stopped. You can see energy really rebounding, materials rebounding. Again, late cycle movers, generally speaking. So, as bullish as we are, not having XLY and XLC in the leading category 2 suggests that, it might not be as strong of a move. We might not be as bullish as we seem on a kind of a headline basis. You look at the biggest companies out there in those three sectors: XLY, XLC, XLK. Apple obviously at 3-month highs, Microsoft near its 3-month highs, Nvidia near its 3-month highs, Broadcom, Google near its 3-month highs, AMD has turned things around, Netflix is up at 3-month highs now. So you can see a lot of stocks are up there, whereas Meta is still below its moving average. Cisco breaking down over the last, since its earnings, pretty hard. And Amazon giving you a bull tag today. So, but a lot of dark green shading and green line across the board on a lot of these Magnificent 7 companies and related companies here. And we'll see, if they are able to maintain that now that we are out of the earnings season that really propelled, the Apples and the Microsofts and the Googles and the AMDs of the world to make their runs. Netflix, since its earnings, has been bullish since that earnings announcement. The same thing with Amazon. All right, that brings us to our trade idea of the day. Let's take a look at Royal Caribbean. All these cruise liners had some pretty good, had a pretty good day today. RCL is the symbol for the stock. As you can see, kind of a nice little breakout. We've been sideways for most of the past few weeks. A little bit of a breakout move today. The MACD intermediate line's in the upper reversal zone above its rising market sentiment. We're nearly 8% above the moving average there. When you look at the weekly chart, let's look at the weekly chart, sorry. The weekly chart here for Royal Caribbean, you can see a very good bullish Hakinashi candle, strong PPO that's rising. Heikin-Yashi differential is positive and getting slightly better. Looking at the 3 green arrow chart, you obviously have 3 green arrows. The histogram is turning back up with the break above the moving average on the stochastics as well. Pretty decent volume on today's move. You've got a good support below us where we're at right now with all those moving averages and the volume node. Even though we are pretty decently above the value area, but we got a pretty decent volume node because of how sideways we've been for the past few weeks. That gives us a little pretty decently strong support there. If you look at the DMI, it's bullish above 30, below 20. So those are, and the ADX has been pretty bullish for a while and continues to rise. The RSI and the CCI are bullish above 200 on the CCI, well above 200 on the CCI, and above 60 easily on the RSI. Looking at the Ichimoku cloud, we are above the cloud. Positive rate of change, green lines above the blue, the intermediate trend strength down there at the bottom, looking very good from that perspective. And then finally, our Bollinger Bands and their Keltner channels closing above the upper band. The bandwidth had really dropped over the past week or so down to the 150-day low range of that Bollinger bandwidth. Momentum had been declining, and the bands came inside the Keltner channels. But today we broke above the upper band and the upper Keltner channel. So kind of a squeeze play that we might be breaking back out to the upside, kind of similar to what we saw over here where we had some bearish momentum, or at least some waning bullish momentum that led to a red dot, and then we broke out of the band and the Keltner channel with a squeeze, and we started the new leg higher, and that's kind of the potential for what you're seeing right now with this particular move. So what I decided to do, again, because the DMI has already been pretty bullish for a while, I decided to just do a bull put spread on this, going to the June expiration, selling the 145, buying the 140. This gives you the trade, getting at least full position size, getting at least a 30% return on risk. So we're willing to lose $441 on that. You can see where my break even is. My break even is essentially where today's breakout was. So as long as we hold this breakout and stay above these moving averages, so there's the break even there. If we were to nullify this breakout, then we don't want to be bullish. And that the whole point we're bullish is because of the breakout. So if we nullify that, we don't want to be in it anymore. That's kind of where I'm okay with that break even. Right now, it's above the 8 and 17-day moving average. You wouldn't expect that that's going to last very long. It's also below, if you look at the range here, it's below the midpoint, so we'd have to drop back into the below 50% for us to get back below this, to the point where we're losing that $400. So I like the setup there. Going into June expiration, we don't have to worry about earnings since we just barely had it after the April expiration, and we'll see if we can't just continue to grind higher with this breakout. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up in a new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.